Hello, guys. This will be lecture number 6 and the last lecture for the material. And after that, we have some exercises for chapter 5. So this is lecture number 6 in chapter 5. And we'll start with learning objective number 9, the last objective for the chapter. Compute the break-even point for a multi-product company and explain the effects of shifts in the sales mix on contribution margin and the break-even point. So we are talking about more than one product and what will be the effect for the break-even point. The definition of the sales mix. Sales mix is the relative proportion in which the company's products are sold. Different products have different selling prices, cost structures, and contribution margins. So if you remember, for the previous objectives, we were talking about one product, same price. So if we have more than one product in different prices, different variable costs, or different cost structures, then what will be the calculation for the break-even and what will be the effect for the net operating income and the sales mix, which is the combination between more than one product. So the relative proportion in which the company's products are sold. When a company sells more than one product, break-even analysis becomes more complex, as the following example illustrates. So let's assume our company, RBC, sells two products, bikes and carts, and that the sales mix between the two products remains the same. Okay. The word sales mix, let's see it's an example. Bikes comprise 45% of the total sales revenue for the company, and the carts comprise the remaining 55% of the sales revenue. So this is called the sales mix. We are selling 45% from bikes, 55% from the carts. Okay. Now we need to calculate the break-even points in units and in dollars. So our question in this objective, what is the break-even point? What is the break-even point for a company sells more than one product in different prices, different cost structures? So the key, or the first point, let's say, for this topic is to know what is the sales mix for the two products. According to our example, we have 45% to be sold from bikes, 55% to be sold from the carts. The sales from the bikes is $250,000. The sales from the carts are $300,000, and the total sales for the company is the total, which is $550,000. The variable expenses are given also: $150,000 for the bikes, $135,000 for the carts, and the total of these two, which is $285,000 for the whole company. The contribution margin is calculated to be 100 for the bikes, which is the difference between sales and variable expenses, 300 minus 135, which is 165,000 for the carts, and the contribution margin for the whole company in a total, which is the 550 minus 285, and this equals to 265,000. I will comment about the variable or the percentages for the whole numbers. Look, The variable expense for the bike, comprises 60% from the sales, which is 100%. So the total here is the 100%. If we have 60% represents the variable expenses, the remaining will related to the contribution margin, so 40%. Again, the relationships between the sales, variable expenses, and the contribution margin. The sales is the base, which is 100%. If we have 60% represent the variable expenses, which means the remains or the remaining percentage, which is 40%, this is related to the contribution margin. Similarly, for the carts, if we have 45% out of the sales represent the variable expenses, which is simply, by the way, 135,000 divided by the 300. This comprises or equals to 45%. So the variable costs as a percentage from the sales is 45%. So then the contribution margin percent for the carts will be 55, which is the remaining up to the 100. I will go back to explain the bicycles. The 250,000 is the total. The percentage for the variable expenses is calculated from 150,000 divided by 250,000. So this is equal to 60%. Now, the remaining will become the contribution margin. 100% minus 60% is equal to 40%. And the 40% represent the 100,000 divided by the 250,000, which is the sales. Okay. Now, the total sales for the company is 550,000. The total of the variable costs, which is 150,000 plus 135,000, this equals to 285,000, 285,000, right? Now, the 285,000 divided by 550,000, this equals to 51.8%. I'm trying to calculate the percentage of the total variable costs to the total sales, which is 285,000 divided by 550,000. This equals to 51.8%. Okay. So we need this percentage. Why? Because we need to calculate the contribution margin ratio. Okay. So if you like, the 100 minus 51.8, this equals to the percentage of the contribution margin. In another way, the 550,000 minus the 285,000, this equals to the total of contribution margin of 265,000. 265,000 divided by the base, which is the sales, this equals to 48.2%. We need this percentage in our calculation. Then we will say, or we will use this percentage afterwards for the break-even. After the contribution margin, look, the fixed costs are related to the company as a whole. So the 170,000 will be deducted from the total contribution margin. It is not related to each product sold. Rather, it is related to the total or the company as a whole. So the 170,000 will be deducted from the whole or the total contribution margin of the company. So 265,000 minus the 170,000, this equals to the net operating income of 95,000. 95,000. Now, I need the percentage of the contribution margin, as I say, 265 thousandths divided by 550 thousandths. This equals to 48.2%. 48.2%. The break-even point for multi-product will use the contribution margin for the whole company. So the next slide will explain the sales mix and the break-even analysis. If we want to calculate the break-even point for a dollar sign or the dollar sign for the sales to break even, this equals to fixed expenses divided by the contribution margin ratio. The contribution margin ratio is related to the whole company, and then the 170,000 represent the fixed expenses related or divided by 48.2%, and this equals to $352,697. Okay, 352 $697,000 sales to break even. Sales to break even. The dollar sales to break even will equals to 170,000 divided by the ratio calculated for the contribution margin, which is 48.2. This is rounded, by the way. That's why we have a rounding error. The answer will be 352,697. Now, if you use the full number for the ratio, we need to divide the 170,000 by 0.48181818. Okay, so the rounding error will have a net operating income of 176. Theoretically, the net operating income here should be zero. Why? Because we are talking about a break even. Okay, so just keep it in your mind. We do have a rounding error. The theory or the concept for the break even, the net operating income should be zero. But assume that we have this number for the dollar sales to break even. The correct number, if you like, just for your practice, the correct number for the sales should be 352,830. This number depends on the full without any rounding. Okay, full ratio without rounding. Assume that we have this number 352,697. Now I have the sales dollar or the dollar sales to break even. The company should sell 352,697 from the two products in order to break even, in order to get a profit of zero. Now this number will be divided into two products using the sales mix that we introduced at the beginning of the question. Go back to the question. We have 45, 55, 45, 55. Okay, then the number for the sales 352,697 will be divided into these two products depending on the 45, 55. So the 352,697 will be multiplied first by 45%. This equals to 158,714 for the bicycles, sales for the bicycles, and 193,983 for the carts. Okay, so the next step is to calculate the sales from each product using the total sales to break even multiplied by the mix 45 and 55 for our example. Okay, something interesting here also. What is the variable costs for each product. Go back to the example. We have 60% and 45% for the two products as a variable expenses. Remember that we are talking about variable expenses, which means 60% of the sales from the bikes, 45% of the sales from the carts. This is the percentages of the variable expenses. We will use these percentages for the break-even analysis. Here, the 60% for the bicycles now times the new sales from the bikes. The new sales from the bikes is 158,714, 158,714, okay? Times 60%, this equals to 95,228, okay? The 60% represent the variable expenses from the sales from the bikes, okay? And the remaining will be the contribution margin. So 158,714 minus 95,228. This will equals the contribution margin from the bicycles to be 63,486. Similarly, the 198,983 sales from carts using the 45 given in the question variable expenses from the sales of carts. So 193,983 times 45%. This equals to 87,293 for the carts as a variable expenses. This number will be deducted from the sales of carts, and then the contribution margin is $106,690. Now, the total for the sales, 352,697. The 51.8 will be multiplied by the total sales to have the variable expense for 182,521, 182,521. Which is the total of variable expenses, okay? 95,228 plus 87,293, 182,521, which represents the 51.8 from the total sales, okay? The difference, which is the contribution margin for the whole company, 170, 176 should be 170,000. Why? Because we're talking about break even. So again, just to remind you that we have a rounding error in this example, but the contribution margin should be exactly 170,000 if we don't have any problem about the rounding. And the net operating income should be zero because we are talking about break even. Okay. That's all for the mix, or a company sells more than one product. Assume that we have 3 products, if you like. We have to have a mix like 20-20 60 or something similar. We do have a mix for the more than one product for a company. Then we need to calculate the contribution margin for the whole company, and we will use this contribution margin ratio in order to calculate the sales dollar sign to break even, and then we will distribute the sales between the products by using the mix first, and then calculating the variable costs from the original percentages to have the contribution margin for each product. That's all for the material. I will do some exercises for the chapter. Okay. So let's start with 5.1. 5.1 effects of changes in sales volume on net operating income. Exercise 5.1. Exercise 5.1. Changes in sales volume and the changes or the effect to the net income. Wiley Corporation's contribution format income statement for the month or the most recent month is shown below. And we do have sales for 10,000 units. The price per 1 unit is 35. So the total sales will be 350,000. The variable expenses per one is $20. And then the total variable cost calculated from 10,000 times 20, this equals to $200,000. And the contribution margin, which is the difference between sales and variable cost, $150,000 divided by $10,000 to calculate the per unit, or simply the price minus variable cost, 35 minus 20 equals 15. The fixed expenses for the company is 135,000, so the net operating income will be 15,000. Now, requirements for this question: consider each case independently. Number one, what would be the revised net operating income per month if the sales volume increases by 100 units? What is the net operating income changes if we change the sales volume by 100 units, We need to prepare a new income statement here. We do have the original for our question. We need another income statement to see what do we have. Now, this exercise 5.1 sales minus variable cost or expenses equals contribution margin minus fixed expenses or costs. This equals to the net operating income. Okay. Now, the original case that we have 10,000 units. Okay. And what we are trying to calculate, which is an increase in volume by 100 units, which becomes 10,100 units. 10,100 units. Okay. The sales here was 350,000, 200,000. Contribution margin is 150,000. Fixed cost is 135,000. And the net operating income will be 15,000. This is the original information about the current situation that we have now. For the 100 additional unit to be sold from this company, we need to calculate the sales for 10,100 units. The sales price was given in the question for $35. The variable expenses per one is $20. Now, the sales for the 10,100 volume will be what? 10,100 times 35. 10,100 times 35. This equals to $353,500. $53,500. Okay. 10,100 times 35. The variable expenses similarly will be 10,100 times 20, and this equals to $202,000. $202,000. The difference between these two numbers will be the contribution margin, which is $151,000. No, $151,500. $151,500. $151,500. The fixed expenses will be the same, no change for the fixed expenses, and then the net income will be $16,500. $16,500. This is the number one, which is what would be the revised net operating income per month if the sales volume increases by 100 units. So we have a 1,500 increase for the net operating income if we increase the units sold by 100 units. Number two, what would be the revised net operating income per month if the sales volume decreases by 100? Decreases by 100. So the new volume for the sales will be what? Decreases means 10,000 minus 100. This equals to 9,900 units. 9,900 units. Okay. Similarly, we need to calculate the sales for 9,900 units. Multiply by 35. This equals to $346,500. 9,900 multiplied by 20 for the total variable cost. This equals to $198,000. Contribution margin will be the difference between these two numbers, $148,500. No change for the fixed costs, which is $135,000, and the answer for the net operating income will be $13,500. So a decrease for 100 units will decrease the net operating income by also $1,500 from 15,000 to 13,500. Okay. Number three, what would be the revised net operating income per month if the sales volume is 9,000? 9,000 only. So I need to calculate the net operating income or prepare the income statement for 9,000 units. 9,000 times 35, this equals to $315,000. Variable cost, which is 9,000 times 20, this equals to $180,000. The difference, which is 135, is the contribution margin. Fixed cost is 135,000, and the net operating income is 0. So be careful that we have a break even for the 9,000 units. We have a break even for the 9,000 units, which means if we sell 9,000, then our revenues will cover our costs. So the net operating income will be 0. This was the solution for the first question, 5-1, 5-1. Let's do 5-4, 5-4. Computing and using the CM ratio. Last month, when Holiday Creations Incorporate sold 50,000 units, total sales were $200,000. Total variable costs were $120,000. And the fixed expenses were $65,000 required. What is the company's contribution margin ratio? Simple. Number one. What is the contribution margin ratio? Remember, we need a base for the word of ratio. The contribution margin referring to, or the base for the contribution margin is the sales. So if we need to calculate the contribution margin ratio, we need to divide the contribution margin by the sales, okay? Which is the base for the contribution margin. Now, we don't have the contribution margin here. We have to calculate the contribution margin. Simply, the contribution margin is equal to sales minus the total variable costs. 200,000 minus 120,000. This equals to 80,000. This gives you the contribution margin as a total. So the contribution margin ratio will equals to contribution margin divided by sales. This equals to 80,000 divided by 200,000. Let's write it together. I will write it here now. Number one, the contribution margin ratio is equal to what? Contribution margin divided by sales, is it? Now, we don't have the contribution margin. Contribution margin is equal to sales minus total variable cost. This equal to what? Sales were $200,000 minus total variable costs were $120,000. This equals to $80,000. This gives you the contribution margin. Now, the contribution margin ratio is equal to what? $80,000 divided by $200,000. This equals to 0.4 or 40%. 40%. Okay. This was the first question. Number two, what is the estimated change in the company's net operating income if it can increase sales volume by 250 units and the total sales by $1,000? Now, we need to estimate the change in the net operating income if we change the sales $sign by $1,000 or 250 units. We have two ways to get the answer for the question number two. we have a shortcut method, or to prepare the income statement for the new sales volume. Okay, I will start with the shortcut. Shortcut means what? Number 2. Shortcut means we have the change in sales. It is given in the question to be $1,000, is it? Now, multiply by the CM ratio, which is calculated to be 40% or 0.4. This will give you the change in the net operating income. Change equals change in net income, which is simply $400. If we have a change in the sales, multiply by the change, multiply by the contribution margin ratio, this will give me the change happens with the net operating income. Let's verify these calculations. Let's verify that we do have a $400 only change in the net income. That's why I open an Excel sheet here. So the Excel sheet will include the 2 income statements. The first one is what? The 50,000 units, right? And the second one will be 50,250 units. 50,250 units. Let's try to calculate the sales, the total variable costs, the contribution margin, the total fixed costs, and the net operating income. The original information for the company, we do have $200,000 for sales, $200,000 for sales, 120 for variable costs, 80 is the contribution margin, 65 is the fixed cost, and the net operating income will be 15,000. Now, if we change to the new level, 50,250, what will be the sales? According to the question, or given a question, go back to the question. What is the estimated change in the company's net operating income if we can increase the sales volume by 250, and they give me the total sales change by 1,000? So we do have additional 1,000 here. So the new number is simply 201,000, right? 201,000. Why? Because it is given. The sales $ total increased by 1,000. Now, if this number is not given, then we need to calculate the price per one. The price per one. From our income statement, originally, we do have $200,000 as sales, divided by how many units do we sell? 50,000 units. 50,000 units. So simply, the price is calculated here to be $4, right? Which is $200,000 sales divided by 50,000 units. Okay. Now, what will be the total variable cost for the new level? Here, we have to calculate the variable cost per one, because also, go back to the question, they didn't give me what will be the change for the variable cost. So we need to calculate the per one multiply by the new level. Now we need to prepare or to calculate the variable cost per one, which is calculated from what? From $120,000 divided by 50,000 units. 50,000 units. This will equals to the total, to the variable cost per one, to be $2.4. $2.4. Multiply by 50,250. This equals to the new variable cost for the new level, which is 120,600. 120,600. Again, guys, they didn't give me the new variable cost or the change in the variable cost. That's why I need to calculate the variable cost per one, multiply it or this by the new level of sales. So how to calculate the 2.4? It is simply 120,000 divided by 50,000 units. And then we have the 2.4 variable cost per one times the new level, which is 50,250. This equals to 120,600. The contribution margin will be the difference between the sales and the total variable cost to be 80,600. No, 80,400. 80,400. Okay. No change for the fixed cost, so it will be 65,000. And then the net operating income will be 15,400. 15,400. Look at here. The change for the change in the net operating income will be the difference between the two net operating incomes or the two amounts, which is 400, right? 15,400 minus 15,000, and the change is 400. This is a verification for the shortcut. Join these two solutions. The shortcut here, the change in the sales shortcut method. The change in sales, which is 1,000 times the contribution margin ratio, 40%, and then the change in the net income will be 400. The verification, which means we have to prepare the two income statements. Any question, guys, here? Another example. Five changes in variable costs, fixed costs, selling price, and volume. Data for Herman Corporation are shown below. Selling price per unit 90, variable expense 63, contribution margin 27, which is the difference. Fixed expenses are 30,000 per month, and the company is selling 2,000 units per month. Okay. The question is, how much will net operating income increase or decrease per month if the monthly advertising budget increases by 5,000, the monthly sales volume increases by 100 units, and total monthly sales increase by 9,000. Okay. Now we need to compare or to prepare a new situation, right? So we need to prepare the income statement for the current sales, Current sales means we are selling 2,000 currently, right? The fixed cost for the current situation is 30,000. And we need to prepare an income statement for the new level. New level will be 2,100, right? Why? Because the monthly sales volume increases by 100 units, 100 units, and no need for the other information for the question. And the total monthly sales increased by 9,000, which is can be calculated from the 100 multiplied by 90 simply. Okay. Okay, then let's prepare an income statement for the new situation and the current situation. We need, this is exercise 5.5, and we need income statement okay. The current sales, which is 9,000 units. Oops. 9,000 units. The new situation will be 9,100 units. No. Go back to the question. It is 2,000, is it? Sorry, 2,000 units. 2,000 units are currently sold. The new volume will be 2,100. Okay, so sales minus total variable costs equals contribution margin, total fixed costs, and the net operating income. Okay, we are currently selling our product by $90. Our variable costs per one is 63, and the difference between these two numbers will be the contribution margin of $27. Okay. Now, for the 2,000 units, we have 2,000 times 90, which is $180,000. $180,000, right? The variable cost for the current situation will be 2,000 times 63. This equals to 126,000. The contribution margin will be the difference, 54,000. Fixed cost is 30,000. And then the net operating income will be 24,000. This is the current situation. Currently, I'm selling 2,000 units. Now, if I'm selling 2,100 units, the new sales will be 189,000. Simply, it is 2,100 times 90, or given in the question that the sales increased by $9,000, but it can be calculated from 2,100 times 90. The total variable cost will be 2,100 times 63. This equals to 132,300. 132,300. Difference for the contribution margin will be 56,700. And also we have a change in the fixed cost here. Look, go back to the question. How much will be the operating income increase during the case per month if the monthly advertising budget increases by 5,000? So the new level for the total fixed cost will be $35,000. $35,000. And then the net operating income will be 21,700. 21,700. So what will be the change It is simply the difference between the two incomes. Our income will decrease by 2,300. Our income will decrease by 2,300. Why? Because we have an increase here for 9,000, but our total variable cost will increase by 6,300. Our contribution margin will increase by 2,700, but we do have an increase in the fixed cost for 5,000. This makes a decrease in the net operating income by 2,300. Okay. Number two. Number two, refer to the general data. How much will net operating income increase or decrease per month if the company uses higher quality components that increase the variable expenses by $2 per unit and increase the unit sales by 10%? Interesting. So we need to variable expenses will be increased by $2. So it will be what? Instead of 63, it will be 65, right? And per unit, and increased unit sales by 10%. Unit sales means what? 2,000 to 2,200. This is the 10%. We have a shortcut also. We have a shortcut. The $2 increase in the variable expense will cause the unit contribution margin, if you like, to no change for the sales price, right? So the 90 minus 63 is equal to 27. If we increase the variable expenses to 65, this means we do have the contribution margin to be decreased to 25 instead of 27, right? So the following impact for the expected total contribution margin will be higher quality components, 2,000 units times 101, which means we increase the sales by 10% from 2,000 to 2,200. 2,200 times 25 contribution margin, this equals to 55,000 minus the contribution margin that we already have, which is for 54,000, and the change in the total contribution margin would be 1,000. Assuming no change in the fixed expenses, the net operating income will also increase by 1,000. Okay, we have a shortcut here and a long way, if you like, to prepare the income statement. Then I will do with you number two. Number two, we have two situations. The easier one to prepare the income statement. So I will copy this one and they will change the numbers, okay? Now, we have, I will delete the numbers here. The new situation will be 2,200 units, right? Why? Because we have 10% increase in the sales volume. This is first. The variable cost will be 65, not 63, right? So the sales, let's calculate it together. The sales for the new volume, 2,200 times 90, no change for the price, is it? 198,000, right? The variable cost will be 2,200 times 65. This equals to 143,000 minus the sales 198,000. This equals to 55,000, right? No change for question number 2. No change in the fixed cost. Refer to the original data. How much will net operating income increase or decrease per month if the company uses higher quality components that increase the variable expenses by $2? And instead of 63, I would use 65. Okay? Per unit, and increase the unit sales by 10%. Unit sales were 2,000, now it becomes 2,200. Now we don't have any change for the fixed expenses, okay? So the 30,000 is there. No change for the fixed expenses, okay? So we do have a operating income for $25,000. Now we have $1,000 increase in our net operating income. Again, we do have, this is a solution of 2, okay? But if we need to use the shortcut for this question, we need what? We need to in this case, we can say, or we can calculate it in another way. The contribution margin change from $27 to 25. Why? Because we increase the variable costs, okay? We increase the, if you like, the 27 represent 90 minus 63, okay? And we change higher quality of the raw materials, so it becomes 90 minus what? 65, okay? Now, we do have a change in the contribution margin for $2. This makes the contribution margin to be 25, not 27, right? Now, we have 2,200 units. Why? Because I'm increasing the sales units from 2,000 to 2,200. Why? Because we do have 10% increase in the sales volume, 10% increase in the sales units, okay? So multiply by 25, this equals to what? $55,000. Okay, this is what? This is the contribution margin, or if you like, expected contribution margin. Expected contribution margin. Okay. Now, this will be compared to the current contribution margin. If you like, 2,000 times 27, right? 2,027. This equals to what? 54,000. Then the change in total contribution margin. Change in total Contribution margin will be what? 1,000. Increase, right? Increase. Because we don't have any change in the fixed costs, change in fixed costs is 0 here, right? We don't have any change in the, so the change in net operating income will be what? Will be $1,000. All these numbers are dollars, okay? That's all. So we can prepare an income statement, or we can calculate it in a shortcut using the contribution margin and compare it to the change in the fixed cost. That's all for today. I will stop in at the beginning of 5, 6. Thank you.